Afternoon, Crypto 101 podcast fam. It is TiVo and Brian with a special edition of a YouTube Live, not a podcast episode, not a rundown, not an interview. It is a live breakdown of the Federal Reserve decision. Breaking news, the Federal Reserve just cut interest rates by 25 basis points. That was as expected. You've heard us talking about it on the rundowns for the last couple weeks. It was market consensus, so no surprise there. But if you're watching this, stay tuned. We're going to break down the betting markets around this. Yes, poly market. We're going to be breaking down the stock market. The S&P 500 had a little bit of a glitch up into the green after the announcement. It is now just slightly in the red with the NASDAQ as well. We're going to cover Bitcoin, Ethereum, and if you hold on, in just 15 minutes time at 2:30 Eastern, Fed Chair Powell is going to take the mic. We are going to be streaming that live with you here, so stay tuned. I'm going to live stream this. We have the direct feed from the Federal Reserve. It is public domain, so we can share it with you, and we are going to watch this thing together. It is a new thing that Brian and I wanted to try. We want to cover this event with you. We'll give some commentary. We want to get you in the mix in the chat. We'll get some questions, so if you're here, you're in the right place. If you're new, welcome. Please like. Bottom right, check our logo. Please subscribe. Brian, as expected, 25 bips. Thanks for doing this with me. And yeah, let's have some fun.
Man, I live for these interviews with you, my friend. You're the best jumping on here. Crypto 101 fam is the best. Always firing us with some great questions out there. And we're going to have some news to report. We're going to see what these markets react to. And, you know, long story short, I do have my little wager out there on the prediction sites, hoping that Powell doesn't come out with a purple tie. It looks like it's going to happen. It was trending at 90% chance of him coming out with a purple tie, but I'm hopeful that maybe he's feeling gold.
Yeah, I mean, again, we're going to dive into the prediction markets first, I think. And then we got our friends. We got people in the chat, but we just want to shout out. We want to shout out Noah. We want to shout out Fitz. Fitz said that 25 bips was already priced in. I can't tell you that you're wrong, Kyle, but it is finally time to fire off the meme.
Cut it, cut it, cut it.
And we don't want to play that too long for copyright reasons, but I've been holding on to that for a year, and I've just been using it, honestly. It's one of the favorite ones that I've made. But finally, it's time. The cut's here. And I guess just a general breakdown, like I said, it looks like the treasury markets are going down a little bit, kind of as expected. The market, the algos like the cut. The S&P, the NASDAQ, the Russell 2000, everything kind of popped right off the jump. But it all comes down to how he speaks in the press conference. And that kind of is going to bring us up to our first thought process of, you know, hey, Fed Chair Powell, what are you feeling today? Brian said he's got the wager out for the tie. What color tie are you wearing today? What are you feeling? What's the vibe today, Chair Powell? And then so I think a fun way to do this, we've got 12 minutes, Brian. So I think overall, if people are new here, let's see how many people we got on board. We got a solid little crowd going. MJB, what's going on? Keep up the good work. Thank you, brother. We basically, again, credit to us. You got to celebrate when you're right. It was market consensus, but we have been talking that we've been waiting for a cut for a while. We think overall that today is a clearing event, and we didn't say whether it was kind of going to be rocket to the upside. It could be negative to the downside. Again, I think that really falters on how Chair Powell discusses the decision, but the stuff that you can get, the little tidbits, if you will, before, there wasn't a ton of dissents. There was a good agreement inside the Fed that it was time to cut. And I think that's really, really important because over the last couple months, obviously the President of the United States has his own style, whether you agree with it or not, and he's very, very vocal to Chair Powell about cutting. And then there was that famous visit to the Fed construction site. That was very funny. But he's been very involved, and there's people that have been worried about the independence of the Fed as an institution, which people think is very, very important. And so the fact that this decision has come out and you've had the majority agreeing around the 25 bips. Now, there's been a disagreement. Somebody wanted 50, one person wanted none, but the majority was all on board for this 25 basis point cut, which I think is going to lead towards the speech of being them joined together around the data. Again, they claim they're data dependent. The data is showing that it's supposed to time to cut. The market's telling them it's time to cut. So I think that's really, really important going into this press conference, that kind of everybody's on the same page, because kind of what we thought, if it was 50 or there were too many people that disagreed with it, the market would get a little spooked. So before we dive into some poly market stuff, Brian, anything you wanted to add on top of that?
No, I mean, you nailed it, TiVo. 25 bips. I think it was Kyle in the chat said that was baked in. I agree. I think 25 bips was baked in. Pretty much everyone was expecting that 25 bips decrease. I love me some rate cuts. I do believe if we cut it up to 50 bips, the market would have probably freaked out a little bit and it would have probably went down and we wouldn't have liked that too much. And that would have had to basically the Fed saying that they made a mistake and they should have been cutting rates a few months ago. Trump would have probably loved that. But 25 bips seems right. I wouldn't be surprised to see more rate cuts. And the consensus agrees with me, more rate cuts coming before the end of the year as well.
Yeah, I couldn't agree more. And we have a new friend here. Jekyll and Hyde said they've been listening on iHeartRadio through the podcast. It's their first live. Welcome, my friend. Thank you for joining us. For all the other new people here, again, we have 9 minutes before the press conference start. 9 minutes. Stick with us. We're going to be streaming that live to you and giving some commentary around it. And if you're new, please, please, please subscribe. And then everybody on the live, give it a thumbs up. It helps us grow and keep doing this fun, free content. And we really appreciate you guys being a part of our community. But let's jump into Poly Market here. I know, as Brian said, and again, okay, let's first disclaim that Poly Market is basically a gambling website. And while anything you hear on this channel is not personal financial advice, we are not personal financial advisors. Brian has a background at DraftKings. I have a background at Barstool Sports. We got a little gambler in us. All right. We like to roll the dice. We like to hit the casino. We love the sports betting. And that's why Poly Market being approved in the US is so exciting for us. We already have Kalshi. I know you're using Myriad, which is an on-chain version to go get some action. So Brian has, for a long shot, Chair Powell always loves to wear the color purple tie. Brian went, is it any color, Brian? Any color other than purple?
I'm on the field. That denim tuxedo, I think, counts if he comes out wearing that.
That would be phenomenal, wouldn't it? So Brian's looking at that. I just pulled up here. What will Powell say during the September press conference? So this is Poly Market. I don't know if I could find it on Kalshi. I put my bet into Kalshi, but let's just scroll down because basically you can see you can start wagering here. Is he going to say inflation over 40 times? Is he going to say over 60 times, the goal, tariff? So you can kind of get the rules there if you got to, have a little tracker in you. I went down on the board here. Oh, this one's down at 47. Let me see what my Kalshi one's currently at. So I took that Chair Powell is going to say the word recession once. All he needs to do is say the word recession once. On this one, it's down to 47. Let me see what it is on Kalshi right now. Kalshi's up to 65%. So here, this is what we were talking about, Brian. These markets are so new. And again, this is the perfect example we've been talking about with arbitrage opportunities, whether it's with crypto, whether it's with worldly news events. These websites, if you're on top of it, and again, you got to understand the risk of it, but there's arbitrage opportunities. Oh man, Kalshi just dropped to 53%. Brian, we're tumbling. Does somebody have a hold of the speech and they're wagering this right now? My thought around the word recession was we can cut rates because he could say, hey, we're looking at the data. We see a less risk of inflation and the numbers are saying from the data we should cut. He could also say, hey, we're cutting now, and he's not going to promise any more cuts for the rest of the year because they're monitoring inflation. They're monitoring the chances of recession, which they should be saying recession is low. That's kind of where I was. I thought, again, I got it at 50-50, so I'll take a coin flip there. I had it at 50. Kalshi was up to 64. As you can see here, this one rose a little bit, 54, went from 47 to 54. This market's moving a little bit, which is exciting. And the fun part is on the live stream, we're going to watch it together.
There's nothing better than putting a couple weight. Again, not financial advice. I have a little risk in me. There's nothing better than watching these mainstream events and having just like a couple, as you guys say, anchored over 3 times. When you told me about the recession bet yesterday, I was like, man, 50-50 says recession. And you and I just started spitting back and forth. Well, he could say this, he could say that. He just needs to say the recession word once. I did have a bet. This is on Poly Market. This is months ago because I've been pretty deep in these prediction markets for a long time. During the election, that Kamala Harris was going to say the word coconut before the election, and that came up as an L, unfortunately. But I couldn't get away from the odds. So it is. This is pretty much wagering, but it makes these events extremely lively. And some people, like you said, the arbitrage is real between these sites. And especially when you start to get into the sports betting world, which I have a background, DraftKings can react a lot quicker, the bookmakers, than the money on Polymarket. Because Polymarket and Kalshi, they're basing all of these percentages on money, PvP money, player versus player money flowing in. So you could go to one site and it'd be 60% and another one have it much lower. So, I mean, you really have to grind to find those. But just from a spectator point of view, it's exhilarating.
Yeah, it couldn't agree more. And I think that's something that on the Crypto 101 podcast channel, again, I look at us, I've explained this to you and the team a lot, just to our listeners. Like, I really view this as a media network. And the community that we've built recently over the last couple months just kind of keeps growing. So this is kind of new content. If you're liking it, please give it a thumbs up. Please subscribe and jump in the comments. Come back after we close out the live and just kind of please comment if you like this type of stuff with the betting markets. Give us some feedback, because it is a type of show that we could try and curate and test out. It's something, you know, me and the team have been talking about. Appreciate Mike Soray, Crypto 101, huge fan from Poland. Very excited to be here very excited what we will hear in a few minutes. So even, guys, this is a world event. Mike from Poland, a listener, a community member. Thank you so much, Mike. We really appreciate having you. Jekyll and Hyde, Brian just signed up earlier today for Momentum Moneymakers VIP. He must have tuned into a live stream recently, or I guess he's listening to the podcast. So that's a podcast sign up. Super excited to hear that. You're going to be hearing a lot more from Brian and Joe in the coming weeks. But we have 3 minutes, guys, 3 minutes until Fed Chair Powell here. If you just joined us, we are going to be streaming Fed Chair Powell's speech live right here. We have some action on it. Brian and I have the word recession to be mentioned once for a 50% chance. And then Brian has the not wearing a purple tie. So we're going to get one of these closed out right away. And then one of them we're going to have to sweat together. But super, super excited. We do have 2 minutes. Maybe let's take a look at the markets here. Anything you're seeing moving on your end? Maybe we could pull up. Let me see if I could pull up Coin Market Cap. Anything you're seeing, Brian?
Yeah, it's pretty flat. This was baked in. Everybody was expecting this 25 bips. I mean, Bitcoin's up a little bit on the hour, which it should be. Bitcoin's one of the best assets ever, so it should be up. But the market's gonna like the 25 bips cut. It's really how Powell's going to come out and talk. Is he going to be hawkish? Is he going to be dovish? I do believe that we're going to see more rate cuts this year by the end of the year. So I'm hoping that we get some positive price action, not just because of my bags. I'm really hoping we get some positive price action. Did you see the thing floating around Twitter, TiVo, about like the housing prices and like just like how priced out? I mean, that's always been a thing. Like with boomers, we're able to buy a house so cheap.
Right. Ahead, I mean, all they had to do, again, we love our boomers. We love all of our community members, and we congratulate them for great investments. But yes, back in the day, all you needed was a couple $100 and a bushel of blueberries, and you could get keys to a house. And then obviously inflation has come for the housing market. There's all those stories of BlackRock buying, and sorry if I keep looking away. I'm just making sure we don't miss Fed Chair Powell coming out. But yeah, the housing market's pretty locked up because you have people from the COVID era that are sitting on their 3% mortgage. You said this to me when we had lunch, like, I'm not moving, bury me in this house. And maybe that's not mortgage rate related, but you don't want to move. Moving's not fun. But if you have a 3% mortgage, you don't want to trade that for a 7% mortgage. So, the housing market's pretty locked up. Prices are high. And then, people do have to move. So over the last, 2 or 3 years, there are a handful of people that have bought homes, new homes. The home builders have been struggling. And here he comes. Breaking news. Let me refresh. I'm watching live on TV. I'm trying to get the feed. All right, Fed Chair Powell walks in the room. Brian needs not a purple tie. Here we go.
I got goosebumps. Uh-oh, that looks purple. That's so purple. That's so obvious in retrospect. That's disgusting.
That's a
Good afternoon.
Oh, good
My
afternoon.
colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. While the unemployment rate remains low, it has edged up. Job gains have slowed and downside risks to employment have risen. At the same time, inflation has risen recently and remains somewhat elevated. In support of our goals and in light of the shift in the balance of risks, today the Federal Open Market Committee decided to lower our policy interest rate by 1/4 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a pace of around 1.5% in the first half of the year, down from 2.5% last year. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles has picked up from last year's pace. Activity in the housing sector remains weak. In our summary of economic projections, the median participant projects GDP to rise 1.6% this year and 1.8% next year, a touch stronger than projected in June. In the labor market, the unemployment rate edged up to 4.3% in August, but remains little changed over the past year at a relatively low level. Payroll job gains have slowed significantly to a pace of just 29,000 per month over the past 3 months. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and lower labor force participation. Even so, labor demand has softened, and the recent pace of job creation appears to be running below the break-even rate needed to hold the unemployment rate constant. In addition, wage growth has continued to moderate while still outpacing inflation. Overall, the marked slowing in both the supply of and demand for workers is unusual. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. In our SEP, the median projection for the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.7% over the 12 months ending in August, and that, excluding the volatile food and energy categories, core PCE prices rose 2.9%. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal.
Recession, say recession.
The median projection in the SEP for total PCE inflation is 3.0% this year and falls to 2.6% in 2026 and to 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by 1/4 percentage point to 4 to 4.25%, and to continue reducing the size of our balance sheet. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to push up prices in some categories of goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, Risks to inflation are tilted to the upside and risks to employment to the downside. A challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. With downside risks to employment having increased, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary. FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.6% at the end of this year, 3.4% at the end of 2026, and 3.1% at the end of 2027. This path is 1/4 percentage point lower than projected in June. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Policy is not on a preset course. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country.
Over halfway.
Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our discussion.
Oh, man. No recession so far, folks.
Ask him a question. Ask him a question.
Thank
Why'd
you.
wear that purple
Chris
tie?
Rugaber at Associated Press. As you know, Fed Governor Stephen Myron has kept his position at the White House, even as he's joined the Fed board. This is the first time, I believe, the Fed's board has had someone with executive branch ties in decades. Does this compromise the Fed's independence from day-to-day politics? And relatedly, how can you maintain the public's perception the Fed is politically independent with this dynamic? Thank you.
So we did welcome a new committee member today, as we always do, and the committee remains united in pursuing our dual mandate goals. We're strongly committed to maintaining our independence, and beyond that, I really don't have anything to share.
Okay, and then just as a quick follow-up, I'm sorry. Can you and other Fed officials have spoken extensively about the impact of tariffs on inflation, although perhaps with many companies appearing to eat the tariffs, tariffs may be impacting the labor market and other parts of the economy instead. Do you see that as a possible outcome here, that tariffs are the reason we're seeing some slowing, particularly in the labor market, rather than in inflation?
The jobs numbers have been
it's certainly
so bad.
possible.
It's like,
how
do you even know?
we have begun to see goods prices showing through into higher inflation, and actually the increase in goods prices accounts for most of the increase in inflation, or perhaps all of the increase in inflation over the course of this year. Those are not very large effects at this point, and we do expect them to continue to build over the course of the rest of the year and into next year. And it's also possible that there may be effects on employment, but that I would say if you're looking at why employment is doing what it's doing, that's much more about the change in immigration. So the supply of workers has obviously come way down. There's very little growth, if any, in the supply of workers. And at the same time, demand for workers has also come down quite sharply, and to the point where we see what I've called a curious balance. It's, typically when we say things are in balance, that sounds good. But in this case, the balance is because both supply and demand have come down quite sharply. Now demand coming down a little more sharply because we now see the unemployment rate edging up.
Nick Timmeros of the Wall Street Journal. Chair Powell, do economic conditions and the balance of risks no longer warrant a restrictive policy setting?
Guy sounds like he works
So
at the Wall
I don't
Street
think
Journal.
we can say that. But what we can say is this, that over the course of this year, we've kept our policy at a restrictive level, and people have different views, but a clearly restrictive level, I would say. So, and we were able to do that over the course of this year because the labor market was in very solid condition with strong job creation and all those things. I think if you go back to April and now look at the revised job creation numbers for May, June, July, and August, you can I can no longer say that. So what that means is that the risks were clearly tilted toward inflation. I would say they're moving toward equality. Maybe they're not quite out of equality. We don't need to know that, but we do know that they've moved meaningfully toward greater equality, the risks between the two goals, and that suggests that we should be moving in the direction of neutral, and that's what we did today.
Under what circumstances would a larger than 25 basis points rate cut be warranted? And how seriously was that option entertained at your meeting this week?
There was recession fears.
There wasn't widespread support at all for a 50 basis point cut today. You know, I think we've done very large rate hikes and very large rate cuts in the last 5 years. And you tend to do those at a time when we feel that policy is a place and needs to move quickly to place. That's not at all.
A lot of traffic on the Fed website here.
I actually took a live bet under 40 inflations. I got them at 16 right now. So
Wow.
I'm over here hanging on every word.
Yeah, let me give this page a refresh, see if we can get back.
Cuts in the last 5 years. And you tend to do those at a time when we feel that policy is a place and needs to move quickly to place. That's not at all hate. And so I think
in place. I guess I'm just, trying to square the shift in the rate forecast in the SEP.
Oof, tough feed here from the Fed. Let me see.
Yeah, people are all over it. Your recession bet's still
sorry for the
okay,
technical difficulties. Yeah, sorry for the technical difficulties. This is not our
towards
fault.
more cuts than just 3 months ago, with the fact that the forecast for unemployment didn't change.
Yeah, I think you could think of this in a way as a risk management cut, because if you look at the SEP, actually, the projections for growth this year and next actually ticked up just a little bit, and inflation and unemployment didn't really move much. So what's different now? What's different now is that you see a very different picture of the risks to the labor market. You've seen, we were looking at 150,000 jobs a month at the time of the last meeting, and now we see the revisions and we see the new numbers. And I don't want to put too much emphasis on payroll job creation, but it's just one of the things that suggests that the labor market is really cooling off, and that tells you that it's time to take that into account in our policy.
The SEP, once again, the median participant has inflation higher than previously expected by the end of next year, and the Fed not getting back to the 2% target until 2028. So I guess I'm just wondering how you characterize the risk to price pressures of kicking off a series of cuts at this point.
Yeah, so I would look at it this way. We fully understand and appreciate that we need to remain fully committed to restoring 2% inflation on a sustained basis, and we will do that. At the same time, we've got to weigh the risks to the two goals. And I would say since April, to me, the risks of higher and more persistent inflation have probably become a little less. And that's partly because the labor market has softened, GDP growth has slowed. So I would just say that the risks there have been less than one might think. And in terms of the labor market, what we're seeing is unemployment is still low. It's still a relatively low rate, but we're seeing downside risks.
Michael McKee from Bloomberg Radio and Television. I'm a little confused by your explanation of the Fed cutting rates because of unemployment. If you think that most of what's happening in the employment area is related to immigration, which your rate cuts wouldn't address.
Political question.
How do you see that as more important
politics
than
out of it?
inflation,
Bloomberg
which has
Radio,
remained
NTV.
almost a full percentage point above your target?
Well, I was saying that what's happening in the labor market has more to do with immigration than it has to do with tariffs. That was the question I was answering. So I wouldn't say that all of what's happening in the labor market is due to tariffs. I mean, you clearly have a slowing in it due to immigration. You clearly have a slowing in demand, which is now perhaps more than that in supply, and we know that because the unemployment rate has ticked up. So
There it is. Unemployment.
So that's what I meant by that.
I think a follow-up. every year since 2015, the SEP has forecast that you would hit your target 2 years later. And this year, this SEP says you're going to hit your target 2 years later. 2% does not seem to be in sight. Does that suggest that the 2% target is not really achievable? And does this present any credibility problems for you in telling people that that's what you're going to do if you can never reach it?
Well, I mean, you're right. It does say we're going to get to 2% inflation in 2028 at the end of 28. But that's, that's literally how you put the projections together. You're writing down a rate path, which is designed to create over the course of the SEP, time frame, 2% inflation and maximum employment too. So that's all that is. No one really knows where the economy will be in 3 years, but the nature of the exercise is to write down policy that you believe would return to the 2% goal over at least by the end of the exercise.
Thanks so much, Elizabeth Schulze with ABC News. The latest inflation report shows that prices are still going up across key categories for many households, including groceries. What will the Fed do if prices pick up more?
So our expectation, and you can see this consistently through the year, has been that inflation will move up this year, but that basically because of the effects on goods prices from tariffs, but that those will turn out to be a one-time price increase as opposed to creating an inflationary process. That's been our forecast. Pretty much all the individual forecasts say that. We can't just assume that though, right? We have to. Our job is literally to make sure that that is what happens, and we will do that job. Right now, the situation we're in is that we see inflation. We continue to expect it to move up, maybe not as high as we would have expected it to move up a few months ago. The pass through of the tariffs into inflation has been slower and smaller. The labor market has softened, so the case for there being a persistent inflation outbreak is less. And so that's why we think it's time for us really to acknowledge that the risks to the other mandate have grown and that we should move in the direction of neutral. So what will we do? We'll do what we need to do, but we have two mandates and we try to balance them. For a long time, our framework says that when our two goals are in tension, this is quite an unusual situation. How do we decide what to do? Because our tools can't do two things at once. What we do is we ask which is farther from, how far is each from the goal and how long is it expected to get to the goal? So, and then we think about those things and we see, as I mentioned, our policy had been really skewed toward inflation for a long time, really. Now we see that there's downside risk clearly in the labor market. And so we're moving in the direction of more neutral policy.
How concerned are you about the slowdown in the jobs market for households at home, especially younger Americans struggling to land a job?
So it's an interesting labor market, and obviously we think it's appropriate that we reduce our rates so that we become more neutral, which presumably will be better for the labor market. You see people who are sort of more at the margins, so kids coming out of college and younger people, minorities are having a hard time finding jobs. The overall job finding rate is very, very low. However, the layoff rate is also very low. So you've got a low firing, low hiring environment. And the concern is that if you start to see layoffs, the people who are laid off there won't be a lot of hiring going on. So that could very quickly flow into higher unemployment. In a healthier economy, healthier labor market, there would be jobs for those people. But now the hiring rate is very, very low. So that's been a growing concern over the last few months. And it's one of the reasons why we think it's appropriate that we begin to shift our policy focus toward a more balanced one.
Steve Leisman, CNBC. Mr. Chair, in the past, during rate cuts, you used the word recalibration. And I wonder if you pointedly did not use it this time. And in fact, when you said policy is not on a preset course, did you mean that as sort of the opposite of recalibration? Are we meeting to meeting, data point by data point? Are we in the process here of getting back to neutral? Thank you.
So I think we're in a meeting by meeting situation. We're going to be looking at the data. Let me say a word about the SEP really here. So we often point this out. What the SEP is, it's an accumulation of the individual projections of 19 people, showing what they believe at a particular moment in time to be the most likely path for the economy and thus the appropriate path for monetary policy as well. And as you know, we don't debate or try to agree on what that is. We just write them down and accumulate them. We do sometimes discuss them. And so we always say we're not on a preset path, and we really mean that. The actual decisions we make are going to be based on the incoming data, the evolving outlook, and the balance of risks at the time the decisions are actually made. So you will have seen that we have 10 participants out of 19 who wrote down 2 or more cuts for the remainder of the year, and 9 who wrote down fewer than, in fact, in a good number of cases, no more cuts. So rather than looking at this as certainty, I would encourage people, as always, to look at the SEP as through the lens of probability. And so there are different possible outcomes and likelihoods rather than this one is certain and this one isn't happening. So that's what I would say.
Thank you for getting to my follow-up question, which was, is the dispersion in the outlook a sign of uncertainty of policy in the meetings to come? Thank you.
You know, it is such an unusual situation. Ordinarily, when the labor market is weak, inflation is low. And when the labor market is really strong, that's when you got to be careful about inflation. So we have a situation where we have two-sided risk. And that means there's no risk-free path. And so it's quite a difficult situation for policymakers. And it's not at all surprising to me that you have a range of views. It's not so much about having different views for the path of the economy, but it's partly that. But it's also partly about what's the right thing to do in light of the tension between the two goals. How do you weight them? How worried are you about one versus the other? And so it's natural. I think it would actually be surprising if you didn't have a pretty wide range of views based, in this kind of highly unusual situation, and we do. So, but we get together, we discuss, we have a great discussion, and then we decide what to do and we act. But you're right that it's a wide dispersion of views, and I think that's understandable and natural in the current situation.
Hi, Victoria Guida with Politico. You've talked a lot about Fed independence and the importance of it over the years, but as markets have questions about what exactly President Trump's intentions are with the Fed, what would you point to as the things they should be watching to determine that the Fed is still making decisions based on, the economic outlook rather than political considerations?
Look, it's deeply in our culture to do our work based on the incoming data and never consider anything else. That's just everybody who's at the Fed really feels strongly about that way. So, you'll know it by the way we talk about what we're doing, by the speeches that people give, by the decisions that we make. You'll know that we're just still going to do that. That's all we do. And we don't frame these questions at all or see them in terms of political outcomes. I think when you get to another part of Washington, everything is seen through the lens of, does it help or hurt this political party, this politician? That's the framework. And I think people find it hard to believe that that is not at all the way we think about things at the Fed. We're taking a longer perspective. We're trying to, serve the American people as best we can. So I think you would be able to tell. I don't believe we'll ever get to that place. I would say we're doing our work exactly as we always have now. And people they're making their arguments, and we're having a really great discussion around these challenging issues. So,
do you see the court case around Lisa Cook as being related to questions of Fed independence?
I see it as a court case that it would be inappropriate for me to comment on.
I have a little action on that. We can.
Thanks, Mr. Chairman. Edward Lawrence from Fox Business. So we saw the preliminary benchmark revisions down 911,000. The revisions for June were the first negative revisions we've seen since December of 2020. How can the Fed base important decisions on rate and what to do with the interest rates on data that seems to be, as you've called it in the past, noisy?
This is a great question.
On the QCEW, the revision that we saw was almost exactly what we expected. it was amazing how close the expectation was. So, and the reason for that is, for the last bunch of quarters, there's been almost a predictable overcount. And I think the Bureau of Labor Statistics really does understand this, and they're working hard to fix it. It's got to do, of course, it has something to do with low response rates, but it's also got to do with what's called the birth-death model, because a good amount of job creation happens around new companies and how many go out of business, how many are founded. And it's just really hard. You can't survey for that. You've got to have a model that predicts that. And it's quite difficult to do, especially when the economy is undergoing big changes. So, and they've been working on that and are making progress on it. But the data we get is still well good enough for us to do our work. To the extent we have issues around data right now, it's about low response rates. That's happened all over really. Response rates are just lower to surveys now, both in and out of the government. And it's no great secret. We want higher response rates, and we need those to have, less volatile data. And the way to get that is to make sure that the agencies that collect the data have sufficient resources to drive higher response rates. It's not a complicated problem, but that's what it takes. It's not a mystery. That's what it takes. The other thing I'll say, Edward, is in the case of the job creation, the response rate is quite low for the first month, or lower for the first month. By the time you get to the second or third month, you're still collecting responses for that last month, for that prior month. And you get to the place where the data are much more reliable by the second and certainly the third month. So it's not that we don't get the data, it's just that we get it a little later.
But for the benchmarks, if that holds, it's 51% of the jobs that we thought were there weren't really there. Shows a weaker job market coming into this year. If you had had that information, would it have changed your mind related to where the interest rates should be? Should there have been a cut earlier?
We have to live life looking through the windshield rather than the rearview mirror, as you know. And all I can tell you is we see where we are now, and we take appropriate action. We took that.
Sounds like a yes.
Yeah.
Fitz was just asking for maybe a little update.
Thanks, Howard Schneider with Reuters. So as you mentioned a minute ago, some margins of the job market would suggest that the slide's already happening. The black unemployment rate in August was above 7%. Declining work week.
We'll keep this on the background just for a little update. The market's starting to roll over a little bit on us. The most interesting thing I'm seeing is bond yields are going higher. The 2 years going higher. The 10 years going higher. Remember, the 10 years directly tied to mortgages.
The economy,
so a lot of people celebrating that this was going to bring down mortgages for everybody. We're not quite there yet because, again, the bond market controls itself, and the bond vigilantes, they're not going to buy the bonds if they don't believe that the economy is on the right footing. You're not going to put money 3, 5, 10, 30 years out in the U.S. economy if you don't believe that the structure that the U.S. economy is running on with this giant debt and inflation is on the right path.
People who are more vulnerable.
The S&P's red. Again, it jumped positive just on the news of the cut and then faded to the red. Bitcoin selling off a little bit. Just got a notification $100 million was liquidated in the crypto markets in the last 15 minutes. Again, that's not a huge amount, the 100 million, but like just something to watch here, where it seems like the market, obviously we knew this was priced in, and now they seem to kind of be, selling off a little bit. I don't think anything too crazy here. Brian, any thoughts before we turn the volume back up here?
Yeah, I think Powell is making it clear there's no rush on these rate cuts, and it's a little dovish as of right now, but the market's not overreacting, but it's not firing up, that's for sure.
Yeah, I think, and the reporters are right to hammer them on the job cuts. We've talked about this on the rundown, how, it's 2025. You're telling me that we're going to all lose our jobs to AI in 3 years, but like we can't get the jobs numbers right and we can't get the data right. Something doesn't feel, I don't want to say, I'm not even saying it's fraud. It just, something doesn't feel right for the process where, you have all these people argumenting and everybody's kind of looking through a political lens down there in DC. And that last question was perfect. It was like, hey, if this jobs data was given to you 6 months ago, would you have cut? Like, you're going on the revised stuff. And, he has to do what he has to do and brush that off and saying we're only looking forward. And it's like, yeah, but you made the argument like we're just data dependent. So, I think we're in an interesting spot here. We're going to turn the volume back up. Probably another 5-10 minutes of this, and then we can do a full recap on the back end and answer some questions from the chat. Thank you all for tuning in.
forecasts have been coming up, as you can see. So labor market unemployment is low, but downside risks, but it's still a low unemployment rate. So that's how we see it.
Hi, Stephanie Rule, MSNBC. Treasury Secretary Scott Bessent has said that the Federal Reserve suffers from mission creep and institutional bloat. He's now calling for an independent review. Would you support an independent review, or are you open to any sort of reform in any areas of the Fed?
I, of course, am not going to comment on anything the Secretary says or really any other officer says. So in terms of reform at the Fed, we just went through a lengthy and I think very successful process of updating our monetary policy framework. I would say there's a lot of work going on behind the scenes around the assets we have in the Federal Reserve Federal Reserve system and at the board. Are they the right size? We're actually going through a 10% headcount reduction through the whole Fed, including the board and all the reserve banks. The employment at the Fed at the end of that will be basically at the same level it was more than 10 years ago. So we will have had zero job growth for more than a decade when we're finished with that, and I think we'll probably do more than that. So I think we're certainly open to constructive criticism and ways to do our jobs better.
Not an independent review?
We're certainly open to to always trying to do better.
Mr. Chairman, Neil Irwin with Axios. There's been some debate lately on whether AI is already starting to affect the labor market in terms of lower labor demand, higher productivity by contrast. Do you buy that? And if that is true, does that have implications for the monetary policy setting?
So there's great uncertainty around that. I think my view, which is also a bit of a guess, but widely shared, I think, is that you are seeing some effects, but it's not the main thing driving it. And so particular focus on young people coming out of college. And yeah, there may be something there. It may be that companies or other institutions that have been hiring younger people right out of college are able to use AI more than they had in the past. That may be part of the story. It's also part of the story, though, that job creation more broadly has slowed down. The economy has slowed down. And so it's probably a number of things. But yeah, it's probably a factor. Hard to say how big it is.
Thanks, Mr. Chairman. What evidence do you see of tariffs showing up in inflation?
Well, if you can take goods, just sort of the broad goods category, and last year, goods inflation was negative. If you go back 25 years, that was the typical thing. Was that goods inflation was goods prices generally went down, even adjusting for quality. So that was not the case during the pandemic, of course. Goods inflation went very high, but we had essentially returned to zero or slightly negative inflation. Now, I think goods inflation over the course of the past year is 1.2%, which doesn't sound like a lot, but it's a big change. So we think, analysts have different views, but we think it's contributing, 0.3 or 0.4, something like that, to the current core PCE inflation reading, which is 2.9%. So it's contributing. What seems to be happening is that, the tariffs are mostly not being paid by exporters, mostly being paid by really the companies that sit between the exporter and the consumer. So if you buy something and you sell it through retail or you use it to make a product, you're probably taking a lot of those costs on and not able to pass it fully along to the consumer yet. That appears to be what we're seeing. All of those companies and entities in the middle, they'll tell you that they have every intention of passing that through in time, but they're not doing that now. To the consumer, the pass-through has been pretty small. It's been slower and smaller than we thought. But the evidence is it's very clear that there's some pass-through.
Listen,
I also wanted to ask.
double cheeseburgers used to be $1 not that long ago, Brian. They're passing through costs at an extreme rate. Okay, don't worry. These companies are passing costs.
I have nothing new on that for you today.
Katarina.
Hi, Katarina Saraiva with Bloomberg News. I just wanted to follow up on one of your answers just a couple minutes ago. We've often heard you talk about how you and your colleagues, do not think about politics. This does not enter the room. But one of your new colleagues does come from this world, right, where everything is seen through this framework of politics and of what party is being helped, and that person is still employed by the White House. How can markets and the public interpret, some of his speeches, for example, and then some of the forecasts that we see today? I mean, the median for this year was moved because of the introduction of his forecast. I'm talking about the number of rate cuts seen this year. What do you say to markets and the public that are trying to interpret, what you guys are saying?
So there's 12 vote, 19 participants of whom 12 vote, as you know, on a rotating basis. So no one voter, can really, the only way for any voter to really move things around is to be incredibly persuasive. And the only way to do that in the context in which we work is to make really strong arguments based on the data and one's understanding of the economy. That's really all that matters. And that's how it's going to work. And I think that is the way the institution, that's in the DNA of the institution. That's not going to change.
And then I wanted to ask about a Gallup poll that showed that Americans now have more confidence in the president than the Federal Reserve when it comes to doing what's right for the economy. Why do you think that is? And what's your response? What's your message to the public?
Our response is we're going to do everything we can to use our tools to achieve the goals that Congress has given us. And we're not going to get distracted by anything. So I think that's what we're going to do. We're just going to keep doing our jobs.
Claire Jones, Financial Times. Given the range of views expressed prior to the meeting, I think there was a lot less dissent today than a lot of people expected. It'd be good to know just what you think the drivers were of coming to that very strong consensus in the meeting, and also on the flip side to just explain why the dot plots are really so scattered between, someone even expecting rates to end up higher by the end of the year to 5 cuts. I mean, what were the kind of range of views you had about, on one side, why there was so much support for a cut today, and on the flip side, why there's so much divergence about what comes next?
So I think there's quite a wide assessment that the situation has changed with respect to the labor market. Whereas we could still say, and did say in July, at the time of the July meeting, that the labor market was in solid condition, and we could point to 150,000 jobs per month and many other things. I think that the new data that we've had, and it's not just payrolls, it's other things as well, suggests that there really is meaningful downside risk. I said there was downside risk then, but I think that downside risk is now a reality, and there's clearly more downside risk. So I think that's broadly accepted. And so that meant different things for different people. Some wrote down, almost everyone wrote down, supported this cut, and some supported more cuts and some didn't, as you will see from the dot plot. So that's just the way it is. I mean, people have, you have people who take this work very seriously, think about it all the time, do their work, discuss it with our colleagues. We endlessly discuss this between ourselves, and then we have a meeting where we put it all out on the table, and this is what you get. And you're right, there's a range of views in the dots, and I think that's, like I said, very unsurprising given the quite unusual, historically unusual nature of the challenges that we face. But let's remember, though, the unemployment rate's 4.3%. The economy's growing at 1.5%. So it's not a bad economy or anything like that. We've seen much more challenging economic times. But from a policy standpoint, the standpoint of what we're trying to accomplish, it's challenging to know what to do. There are, as I mentioned earlier, there are no risk-free paths now. It's not incredibly obvious what to do. So we have to keep our eye on inflation. At the same time, we cannot ignore and must keep our eye on maximum employment, which is those are our two equal goals. And you will see that there's a range of views on what to do. Nonetheless, we came together today at the meeting and acted with a high degree of unity.
Thank you, Archie Hall from The Economist. You mentioned earlier that job creation was running below your guess at its break-even rate. I'd be curious to hear a bit more about that and where you think the break-even rate is.
So there are many different ways to calculate it, and none of them is perfect. But it's clearly come way down. You could say it's somewhere between 0 and 50,000, and you'd be right or wrong. I mean, there's just many different ways to do it. So wherever it was, 150,000, 200,000 a few months ago, it's come down quite significantly, and that's because a very lower amount of people are joining the labor force. The labor force really not growing much at this point, and that's a lot of where the supply of labor was coming from over the last 2 or 3 years. So we're not getting that now. We've got much lower demand. It's interesting that supply and demand have really come down together so far, except now we do have unemployment ticking up just one tick outside of the range where it's been for a year. 4.3% is still a low level, but I think this speedy decline in both supply and demand has certainly gotten everyone's attention.
I'll follow up if I may. You mentioned the downside risk to employment a fair amount, but it's striking that measures of kind of activity and output for the third quarter, those that we have, seem pretty strong. The Atlanta Fed's GDP now is very strong. You mentioned strong PC numbers as well. How do you square those things? Is there a chance actually could be upside risk to the labor market if those activity measures are right?
Well, that would be great.
I can't believe nobody's asked the question of, is there a risk of recession?
Big tension there, but it's gratifying to see that economic activity is holding in.
Somebody should tee him up.
It's a good.
Is everybody against my Kalshi bet here?
Consumption was stronger than expected. What we got earlier this week, I guess. And also we're getting, a fairly narrow sector is producing a lot of economic activity, which is the AI build out and
AI
business investment. So
that was
we watch all of it, and I would say we did move up the median for growth for this year. Actually moved up in the SEP between the June and September SEPs. So, and really the inflation and labor market didn't change much. It's really the risks that we're seeing to the labor market that were the focus of today's decision.
Nicole. Hi, Nicole Goodkind with Barron's. Thank you for taking my question. Given the cumulative impact of high interest rates on the housing sector, I'm wondering how concerned you are that current rate levels are exacerbating housing affordability issues and potentially hindering household formation and wealth accumulation for a segment of the population?
Housing is an interest-sensitive activity, so it's at the very center of monetary policy. When the pandemic hit and we cut rates to zero, the housing companies were incredibly grateful, and it was really, they said that was the only thing that kept them going, was that we cut so aggressively and provided credit and things like that, and they were able to finance because we did that. The other side of that is when inflation gets high and we raise rates, and you're right, it does burden the housing industry, and so rates have come down a bit, and as that happens, we don't set mortgage rates, but our policy rate changes do tend to affect mortgage rates. And that has been happening, and that'll of course raise demand. Lower borrowing rates for builders will help, builders will help supply, and so some of that should happen. I think most analysts think that it would have to be pretty big changes for it to matter a lot, for the big changes in rates to matter a lot for the housing sector. And the other thing is by achieving maximum employment and price stability, that's a strong economy. That's a good economy for housing. And then the last thing I'll say is, there's a deeper problem here. There's not a cyclical problem that the Fed can address, and that just is a pretty much nationwide housing shortage. Or a lot of places in the country just don't have enough enough housing for people, and all of the areas around metropolitan areas like Washington, for example, are very built up, and so you're having to build farther and farther out, and so that's where it is.
And just a quick follow-up. During the last SEP, or the press conference following the last SEP, you seemed to indicate that policymakers lacked conviction about their projections, and I'm wondering if you still feel that way.
Forecasting is very difficult even in placid times, and as I've mentioned before, forecasters are a humble lot with much to be humble about. So I think right now is a particularly challenging time, even more uncertain than usual. And so I don't know any forecaster anywhere, really. Ask any of the forecasters whether they have great confidence in their forecast right now. I think they'll honestly say no.
Jennifer. Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. If you're cutting rates, why continue to reduce the size of your balance sheet, then pause the unwinding?
Well, I think we're cutting the size of our balance sheet quite marginally now. As you know, with the balance sheet, we're still in an abundant reserves condition, and we've said that we would stop somewhat above somewhat above an ample reserves level. That's where we are, and we're getting closer to that. We're monitoring it very carefully. We don't think that has at all significant macroeconomic effects. These are pretty small numbers moving around inside a giant economy. The level of runoff is not very large, so I wouldn't attribute macroeconomic consequences to that at this point.
And at his recent confirmation hearing, Stephen Myron brought up that the Fed actually has 3 mandates from Congress, not just jobs and stable prices, but also moderate long-term interest rates. So what does Congress mean by moderate long-term interest rates? How should we understand that when we see the 10-year Treasury moving? And how do you think about this part of the mandate when policy choices like rate cuts or balance sheet reductions affect the long end of the yield curve?
So we always think of it as the dual mandate, maximum employment and price stability, for a long time, because we think moderate long-term interest rates are something that will result from stable inflation, low and stable inflation, and maximum employment. So we haven't thought about that for a very long time as a third mandate that requires independent action. So that's where that is. And there's no thought of, as far as I'm concerned, there's no thought of considering that we somehow incorporate that in as something in a different way.
I feel like this is a much longer
Thanks,
Q&A
Chair Powell.
period.
Matt Egan from CNN. We recently learned that average FICO credit scores are down this year by 2 points, the most since 2009 during the Great Recession, and delinquencies are high for car loans, personal loans, credit cards. How concerned, if at all, are you about the health of consumer finances, and do you expect today's cut will help?
So, we're aware of that. I think default rates have been kind of ticking up, and we do watch that. They're not at a level, I don't believe they're at a level where overall they're terribly concerning, but it is something that we watch. Lower rates should support economic activity. I don't know that one rate cut will have a visible effect on that, but over time, a strong economy with a strong labor market is what we're aiming for, and stable prices. So that should help.
I thought you might get
this rate cut is coming at a time when the stock market is at or near all-time highs, and some valuation metrics are elevated historically. Is there a risk that cutting rates could overheat financial markets, potentially fueling a bubble?
We're tightly focused on our goals, right? And our goals are maximum employment and price stability. And so we take the actions that we take with an eye on those goals. Separately, and that's why we did what we did today. Separately, we monitor financial stability very, very carefully. And, I would say it's a mixed picture, but households are in good shape. Banks are in good shape. Overall, households are still in good shape in the aggregate. And I know that people at the lower end of the income spectrum are under pressure, obviously. But from a financial stability perspective, we monitor that picture. we don't have a view that there's a right or wrong level of asset prices for any particular financial asset, but we monitor the whole picture, really looking for structural vulnerabilities. And I would say those are not elevated right now.
Jean, we'll go to you for the last question.
Last question.
Hi, Chair Powell. Jean Young with M&I Market News. I wanted to ask about inflation expectations. You've said the Fed can't take the stability of inflation expectations for granted. You mentioned at the short run, they've gone up a little bit. I wonder if you can talk a bit about that. And then also at the long run, wondering, do you see evidence that the debate over Fed independence and the growing deficit is putting pressure on inflation expectations?
So as you said, shorter term inflation expectations have tended to respond to near term inflation. So if inflation goes up, inflation expectations will predict that it takes just a little while to get back down. Fortunately, throughout this period, longer term inflation expectations both break even in the markets, and almost all of the longer term surveys.
Producers cut
Michigan
here.
being a bit of
We're
an
going to
outlier.
wind this down, folks, and get into the commentary section. We appreciate everybody joining us. If you're new, give us a like. Please subscribe. And if you've been sticking around, we appreciate it. As said, we're going to answer some questions. Get active in the chat. Make some statements, whatever you think, or ask some questions. Brian and I are kick it around. I'll keep him on the screen just in case something goes crazy here. But overall, markets are pretty, I'm going to call it flat, Brian. We're going to see the Dow's up 0.5%, S&P basically flat, down 0.08, NASDAQ down 0.27, Russell up 0.5, 0.5%. That's the one that's sticking out to me, because when I go over and I bring this over into the crypto markets, I think of the Russell kind of as that beta play on kind of the economy and rates. You have a lot of smaller companies there that need to take out and borrow money. You have a lot of the banks and the financials in there as well, that I think could, and he's just walking off the stage now, so we're going to cut the feed, and that will be that. And so what I compare the Russell 2000, some small caps, is I actually compare that to a beta to Ethereum, and crypto as a whole, but specifically Ethereum. So kind of seeing that, again, it's a pretty flat market, which I think is really good. I think kind of back to the front end, we had consensus. The consensus was to cut for the Federal Reserve. Everybody seemed to be lockstep in line. The Chair Powell seemed very, very, very confident about the decision. The biggest headline I took away was there are no risk-free paths. I thought that one stuck out to me, meaning that, they had to make a move today and they're monitoring it forward. I thought it was a great job by the press room hammering home the jobs numbers. A couple different people brought that up back to back. But overall, a clearing event. This is now behind us. Everything happened as anticipated. There were no curveballs in that Q&A, which I think is very good. There's a couple more Fed meetings this year, and you got to wait for the data. And you definitely want to digest it. This is why we're doing this. We're having fun. I reserve the right to change my opinion tomorrow or next week. My initial opinion, which is why you guys are still with us, I'm kind of bulled up. I'm kind of bulled up because there's going to be a lot of people saying, no, I'm serious. And I know we're permables. We taught me and you're the permables.
Yeah, well, that's how I was laughing.
So we go back to a year ago in December, where we had the first rate cut a year ago, and then a year ago, literally today, and then we kind of went into December, and everybody was going like, "Oh my God!" Like everybody was behind on the Trump trade, and there's this rally into the end of the year, and it makes sense to cut another 25 bips. And I've said this on the podcast. I made a lot of bets on the end of year rally last year and got absolutely torched by the man that we just watched for the last 30 minutes. He went up there, there was no cut, and then he went on his Q&A and speech rant and absolutely buried the economy, just like talking about how there's a lot of unknowns and there's risks and this and that, and it just absolutely tanked. And so I think it's really important to see not just Chair Powell have a much calmer tone. He seems confident, he seems in control, and I think he has the confidence of the Fed behind them that this was the right move, even though there has been political lenses surrounding this body for really the last 6 months plus. So any hot takes from you off the jump?
Yeah, I mean, it was pretty much as expected. There were some things, I mean, he said it was a risk management cut. I felt like the overall vibe started a bit bullish on economic progress. He said inflation risks were down since April, growth was holding, but definitely started to move into the more hawkish territory, prioritizing, the data-driven decisions and dismissing the tariff-driven inflation as short-lived. But it was probably hawkish neutral overall. Did he say the vote, I think, for the rate cut was 11-1? So pretty much overwhelming support there. I agree with you. It's probably more of a neutral tone. We're going to probably just chop and move sideways. I don't think we'll see any violent moves up or down. But like you said, this was behind us. I think I saw like 105 million was liquidated from the crypto markets during that speech, though, in perps.
Yeah, we missed out on. You lost the bet for doing betting markets. Brian took an L on the tie. Tie was purple. I took an L on recession. I really, really thought that was it was a 50-50 going in. I could have cashed out before it jumped up to 65, and I don't know. I'm really, really shocked that nobody, with all the jobs data, the revisions that we've seen, and this weakening, and he kept saying, the economy's weakening. There is no risk-free path. We're losing jobs left and right, and nobody was like, hey, how does the Fed board view a possible recession in 26? Is that on the table? Is there any data that you're seeing? What are we doing in that press room? Everybody's just trying to get their own little political punches in, and we're not asking the hard questions. And now I'm out of a bet, and I take the fat out on that as well. But it was a fun little sweat.
It was a good sweat. I mean, he hit the employment number of over 20 early on. I have tallies all over my sheet. He nailed it with the good afternoon. He introduced it to everyone. Probability. He said pandemic. He said median. He said AI. That was one. But yeah, recession did not happen. He did not say Trump. He said Mr.
Dude, I think AI was like less than 50-50. AI was going off at like 80-20.
Yeah, that was a juicy one. The inflation one is super interesting right now because I had it right around 40. It was 40 plus, and that's right now in review at 99% chance. So they're recounting it, but it definitely didn't get to 50 plus. I guess there wasn't much there, I mean, I think everything that he said, he really harped on the jobs and the labor, but there wasn't much there that was unexpected. I think the most interesting part of that was that the 25 bips cut was a risk management. So that goes to show that it's not like of major urgency. Curious to see what the chances of another cut coming in the next meeting would be. Looks like it's still
right now. I know it's probable. The probability is 3 cuts, including this one. 3 cuts for the end of the year is leading the clubhouse right now on the betting markets. So that means that there's either a 50 coming at one meeting or a 25-25 for the next 2. And again, that can change. That kind of stuff can change pretty quickly based on, that CPI, PPI, when all that data comes out. And we cover all that stuff on the rundown. So, if you're new here, this is your spot for all things macro markets, but also, specifically on our other shows, we really dive into crypto. So if you're joining us and you're new, give us a like, hit the subscribe button, turn on notifications, and Brian and I'll kick it around for another couple minutes. If you have any questions, please drop the questions in the chat, and we'll revisit those in a second before we close out, because we still have a handful of people here. So if there's any questions, guys, drop them in the chat. We'll kick around another topic and see if there's any questions before we close out here. I will say this. I think there is a risk of over-easing, in the sense that I thought Chair Powell did a great job of, he always doesn't want to give the markets too much. Very rare, unless it was like COVID, the COVID example where the economy is falling off a cliff. Everybody thought the world was ending, and he came out and was like, don't worry, everybody, we're going to inject a ton of liquidity into the markets. So if you're around for those days, that's when, the 2020 run of Bitcoin, and, that led to the GameStop saga in 21, where the economy's been on a sugar high for 2 years, and then obviously there were the raises in 22, and then CapEx pulled back, and now we're kind of in this holding pattern AI revolution CapEx cycle, and I think that's kind of the big picture here is when is the he mentioned AI in the speech, which again was a big winner for some people, but when it comes to AI, all these capexes, and you see people buying these NVIDIA chips, and Meta and Google and Microsoft going out and OpenAI spending $500,000, $1 million. They're giving out sports contracts like $50 million signing bonuses, is crazy stuff in the AI world. And all that stuff's called capex. That's investment into the future. And so what I think the businesses are, and you got to remember, dude, NVIDIA, Facebook, or Meta, and OpenAI, these companies, they're big. They're bigger than countries. Their GDP is bigger than most countries. And so you might see sitting there being like, oh, well, you know, NVIDIA and Meta and the companies, they're not going to dictate what we do. And it's like, well, they do have a say. They do have a say because they employ a ton of people and they spend a ton of money in this little, again, we talk about the flywheel in some of our projects. It's really just one big flywheel of the economy. And so I think that if these companies stop hiring, start cutting heads, and stop investing in CapEx, which again is hiring and a lot of other things, then that freaks out the overall kind of watchers of the economy, if you will. And so I think that's something to consider and why technology has the front seat right now and just this era of investing. And I think Bitcoin and Ethereum and all of our cryptos, like we talk about, can be kind of a beta play to that, like I just talked about with the small caps.
Yeah, well said. And again, it doesn't feel like the crypto market's overreacting at all. I mean, Bitcoin's down 0.09% in the last hour. Ethereum's up 0.5%. We're, you know, it's a pretty neutral discussion there. We'll see how everyone digests it and breaks it down. But man, I can't believe he didn't say recession. That guy at the end, he was teeing it up.
I know.
He was teeing it up.
He was leaning there.
He was like the Great Recession. I was like, you might get it here. He might say something, but no. It seemed like he just went on and on about something that we knew for a while. No major surprises. I think the crypto market, I think the overall market's going to kind of shrug it off. It's in our rearview mirror now. Let the markets breathe a little bit, and we're back up. There's a lot of other catalysts out there for, especially the crypto markets, to thrive. So this is one less thing hanging over our heads, and we'll see how it all continues to go.
Yeah, there is, as we cover always in the rundowns, there's a lot of news around the crypto markets right now. And again, couldn't agree more. It's a clearing event. It's past. The markets are going to breathe. There could be, you know, I would probably favor a little bit of breathing downwards, just slightly. Just because, again, we got to remember we're at all-time highs, so you got to be looking, what's the catalyst? And everybody's kind of going to be waiting for that next round of data and kind of those Q4 juicy numbers that people are waiting for. But specifically for crypto, I know yesterday you had Michael Saylor, you had Tom Lee, I think Dan Ives. I believe they were all in the same room for kind of like a Bitcoin crypto ambassador event where they were talking about the Bitcoin strategic reserve. So that's stuff to keep an eye on. And yeah, obviously Tom Lee is just buying up Ethereum like a vacuum. All stuff that we're going to cover. Didn't quite get any questions, but Joshua Lauer says, late hey, but I'm always listening on iHeartRadio. Hope all is well and your bags are fat. Josh, thank you so much. Appreciate you tuning into a live. East Coast Lobster kind of agreed, basically. He was saying this while I was giving my little rant there, but kind of keeping an eye on these, you know, mega companies and all the jobs created in this AI mega cycle. Jekyll and Hyde, looking forward to the live tomorrow. So maybe I hope I didn't make a mistake on my post, but we're going to go live on Friday. So Friday is going to be back with Brendan. We're going to do a big TA session. It's going to be longer than usual. Let me pull up my calendar here. Friday the 19th at 1 p.m. Eastern. So make sure if you're free Friday at 1 p.m. Eastern, we're going to be live here on YouTube. If not, we're going to put that one up on audio as well. Fitz saying thank you. Brian, any last final thoughts?
No, it was, you know, hawkish neutral. The market's going to shrug it off. There's a lot of catalysts, like you said. One thing that you just said that sparked something in my head is we did have major players talking about the Bitcoin strategic reserve yesterday. So that almost felt like it went under the radar, in my opinion. Obviously, in our circles, we were talking about because it was such huge news. But we have a major push still happening for strategic reserve. And I'm a big fan of it. I think if and when that happens, we're gonna see a candle like we've never seen before. But we still have ways to go, and that's okay. Nothing goes up in a straight line. We need these baby dips here and there, good buying opportunities. And you and I are both the perma bulls in the crypto world. So just fired up to see how it all shakes out. This is a clearing event. It's in our back window here, and some time to breathe.
Yeah, couldn't agree more. Jekyll and Hyde, if I made a mistake there on the post, I'll go correct that after we go live. It is interesting. The bond market still are basically rising. The 2 through 30 year on the bond is rising again. That's a small intraday move, nothing crazy, but something to keep an eye on, because everybody's like, oh, the Fed's cutting rates, the Fed's cutting rates. I'm going to get a cheap mortgage. I'm going to refinance. And I don't think it's as simple for this cycle. Not saying it won't happen. I think it's positive, because we've talked about this inflation number of like what's keeping inflation high. And it's like car insurance. And there was one other wild one. It was housing. When these numbers, when the inflation wouldn't come down, we remember going through the reports on the rundown, and it was like housing, car insurance, and then there was something else. And the 2 out of the 3, like, rates didn't affect. But housing is affected by rates, and it really helps the everyday person for household formation, for refinancing and unlocking capital. So, and then obviously credit card rates and helping people that, kind of run the number up on their credit card rates and run a little bit of debt. So we're going to be covering all this for everybody. That's going to be it for our first ever live. I think it was super successful, tons of views, tons of engagement, something we're going to look forward to doing more for Fed or other decisions. If you're new, again, before you leave, toss the video a like. We really, really appreciate it. Drop a comment after we're done if you like this type of content, and we'll do more of it. But until next time, we'll see you guys later this week with some more live crypto rundowns. Enjoy the rest of your day, everybody. Bye-bye.